It's a day that comes for all of us, whether we're ready or not. It's not a birthday or an anniversary. It's the day you open your investing app, glance at your portfolio, and see everything awash in a brilliant, unmistakable shade of red. A deeply unromantic red. Your heart skips a beat, maybe you sigh, maybe a vague unease settles in your chest. You know the one. The day your portfolio takes a hit. What seasoned investors often call a red day. For a beginner, it can feel like a shock. For the experienced, it might be a frustration. But for everyone, it is a psychological test. The biggest question isn't, why is it red? The market always has its reasons, sometimes logical, sometimes emotional. The biggest question is, what should I do now? The moment between recognizing the drop and taking your next action is the most critical one. It's where calm investors separate from panicked ones, where long-term plans are either honored or trampled by fleeting emotion. And today, I'm not giving you vague advice. I'm giving you a concrete tool, a red day checklist. Think of it like a pilot's pre-landing checklist during turbulence. They don't panic, they pull out the list and go step by step. You can do the same. Step 1, close the app. No, seriously, close it. The first and most powerful action is an act of inaction. When you see red, your primal instinct screams at you to act immediately. But acting at the peak of emotion is a recipe for disaster. Your goal right now is not to save your portfolio in the next 5 minutes. Your goal is to protect it over the next 5-10 years. So, close the trading app, close the browser tab with the stock ticker. If you have to, physically put your phone in another room. This simple physical act creates a crucial psychological distance. It stops you from hitting sell in a panic. Take a deep breath. A red day is not a medical emergency. No one ever died from a paper loss. Give yourself at least an hour, or better yet, until the end of the day before you decide to do anything at all. You are taking back control from your emotions. Step 2, separate the emotional storm from the actual problem. Once you've settled a bit, ask yourself 2 key questions. Question 1, what has actually changed? Did the market drop 3% because of a politician's offhand comment? Or did your stock drop 15% because the company reported a massive loss and the CEO resigned? The first is noise, an emotional storm. The second might be an actual problem. Most red days are just normal market adjustments, background noise. Question 2, does this affect my original investment thesis? You bought that stock because you believed in the leadership, the product, its industry position for the next 5 years. Does a single down day change any of that? If the answer is no, this is just a bump in the road. If the answer is yes, say the company's fundamentals are deteriorating, that's a signal to reevaluate, not to panic sell, but to reassess systematically. Step 3, pull out your roadmap, your personal investment plan. You wouldn't drive cross-country without a map. Don't invest without one either. On a red day, you need that map, the personal investment plan you wrote when your mind was clear and calm. It should state your goal, what are you investing for, retiring early in 20 years, a house down payment in 5, your time horizon, how long are you invested for, and your risk tolerance, how much volatility did you expect. Read that plan again. Does the market being red today change your retirement goal 20 years from now? Does it make the house you want in 5 years disappear? Almost certainly not. This simple act is like looking at the sun to reorient yourself in a desert. It recenters you on the big picture and pulls you out of the emotional sinkhole of a single day's volatility. Step 4, check your portfolio's health, not its wounds. Instead of staring at the total dollar amount lost and feeling pain, switch to doctor doing a checkup mode. Look at your portfolio objectively. Is diversification still intact? Is your entire portfolio concentrated in one sector, like tech, that's falling together? If so, that's not the market's fault. It's a lesson for better diversification. Has your asset allocation broken down? You plan for a 60% stock, 40% bond portfolio. If stocks plunge, maybe it's now 50-50. This accidentally made your portfolio safer than your original plan. That's an interesting signal. Which holding dropped the most and why? Don't just look at the percentage. Dig for the real reason. Did it fall with the overall market or on its own bad news? This helps you separate victims of crowd psychology from patients with internal problems. Step 5. Decide on an action, if any, based on your plan, not fear. After all the steps above, now you can consider action, and this action must be a deliberate choice, not a reflex. Option A. Do nothing. This is often the smartest choice if your plan is intact, your portfolio is healthy, and you're investing for the long term. Patience is an action. By not selling in panic, you are buying more future discipline. Option B. Rebalance. If your checkup shows your asset allocation is way off target, this might be the time to rebalance. Example, stocks fell, so your stock allocation is now lower than you want. You could use some cash to buy more of what's on sale to bring the ratio back in line. This is the act of a disciplined investor, selling a bit of what went up to buy more of what went down, doing the exact opposite of the crowd. Option C. Cut losses with control. If you did discover a true sick patient in your portfolio, broken investment thesis, deteriorating company, you might decide to sell. But do it with a preset rule, e.g., don't let a loss exceed 15 to 20% with a very good reason. This isn't selling from fear, it's selling because you have a clear rule. Step 6. Leverage the sale if you have planned cash. This step is for the prepared. A market-wide red day is like a Black Friday sale for long-term investors. If you have a planned cash reserve, not your emergency fund or rent money, this could be an opportunity to buy quality assets at a discount. Remember, don't dump it all in at once. The market could keep falling. Dribbling it in over time helps you stay calm and avoid the obsession of trying to buy the exact bottom. Step 7. Debrief and take notes. After the dust settles, spend 10 minutes journaling. How did you feel today? What did you most want to do? What did you actually do? This note is incredibly valuable. It teaches you about your own psychological reactions to volatility, so the next time a red day comes, and it will, you'll face it with much more calm and professionalism. At the end of a red day, the most important thing isn't how much money you made or lost that day. It's what you kept. Did you keep your calm? Did you keep your faith in the long-term plan? Did you keep the good stocks without dumping them in a panic? If the answer is yes, that is a true victory. The market is a marathon of patience, not a sprint of quick reflexes. Keep this checklist handy, and the next time you see red, instead of fear, you'll smile and know exactly what to do next. If you found this checklist helpful, save this video or share it with a fellow investor so you can both navigate every market swing with more confidence.